Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Hey, good morning. Welcome to the BOGART Effect. We have Chaz and Brian with me today, and we're going to talk about avoiding information on the internet. You know, and I think the backstory here as we're coming up with the idea for this podcast was there's so much bad advice on the internet. I mean, whether it's social media, whether it's YouTube, whether it's something, an article somebody writes, and even honestly, some of the credible sources, you can get really bad advice on the internet. And I think it's important as we're kind of setting the stage for today's podcast, we have to remember that the media monetizes from selling really on emotion. And the number one emotion that they try to, let's just say, fixate on is fear. Mm-hmm. And I also think we're now seeing a state where the media has a dramatic impact on market implications as we have a lot faster access to information, but simultaneously we have a lot faster access to unaccredited or not necessarily reliable information. And it causes people to make emotional responses associated with it. And ultimately, that's where we really wanted to spend today's podcast. So why don't we dive in and talk about some just common examples of bad advice that we find on the internet?
Yeah. James, thanks for having me on. Thanks. Always good to be on the podcast. Chaz.
DOG.
Chaz, welcome.
Glad to be here.
I actually wasn't going to come to the podcast today because I saw an article before I got to the office. I was dropping my kids off, and it was a link that I found that if I would invest in this stock today, I was going to get a 300-400% return because this was going to be the next big thing. So I thought about it. And so this might be my last podcast because I went hard and I went heavy. And so that's like one of the biggest, worst pieces of advice that can be, exacerbated through the internet is this is the next one, the next big thing. And if you don't jump on this train right away, what are you doing? You see these other companies that are out there that have had just exorbitant growth in the last several years, and everyone's trying to find that next one. And, there's this, this appetite to fuel that for individuals. And, I think a lot about that. And it's like, who's gaining from this?
Well, it's ultimately someone's on the other side of that train, right? Like, and again, I get to blame the media for that, right? Like they've used a medium to be able to really accelerate. But Chaz, what about like the meme stocks, right? I mean, you want to talk about a sensationalization that candidly had zero fundamental change that had a dramatic impact on several companies. And I would also say that's the media.
Yeah, I think it ties back to the overall polarization of those stocks, especially during COVID. And it was a personal experience for me during college. We had a lot of free time on our hands and unlimited access to the internet. And I had friends who made these drastic decisions to invest. And it was tough to see because everybody wanted to build a huge pile of cash quickly without doing adequate research. Like you said, there was nothing that fundamentally changed about these companies. It was people on Reddit and Twitter making decisions for people, saying to invest when there was really no fundamental backing, no technical backing. It was all sort of a guess.
Well, and in some instances, these are not even financial advisors. These are just, people.
Gamers.
Yeah. Gamers that were but the one that I think I love the most is, and you kind of just touched on it, but under diversification. Anyone who says you need to put everything in 1 or 2 or 3 or even just the Magnificent Seven. I think really it comes back to there's a lot of risk associated with lack of financial literacy. And I think related to that, there's a lot of people who come in and say, I'm an expert in this with really not having a lot of expertise in that. They make an opinion and they might hit one, right? Like let's say 2008, everybody called for the great financial crisis and short the market. And next thing you know, they've been calling for it 15 times since then. And if you reacted just based on that piece of data, because that person called it, or related to that, you go heavy in a concentrated position that may or may not be appropriate for your risk profile. I have a good friend of mine. His entire portfolio is Tesla stock and Bitcoin. That's it. And granted, he's in his 30s and he's got a long time horizon to be able to endure. But for him, he thinks that that's the best investment strategy.
Different than my risk profile.
And I would probably say I'm the most aggressive of the group here. And that's different than my risk profile, right? And I certainly would say that's very different than the rest of our customer base's risk profile as well.
Yeah. And that's what it comes down to, though, is that you're an individual. Right? We just mentioned risk profiles and we can have different risk profiles. And what advice is being given to a mass population? Yeah. If you're seeing something on the internet, maybe 10 million people are seeing it. And maybe for 0.5% of the people, that's good for them and their situation. But everyone's different. And so that's where you can't take what other people are saying or doing, whether it's the individual that predicted the stock market crash in 2008 is going to say it again, or Dottie posted on Facebook that this is a good buy and did well for her, so we need to do this too.
Well, and I think no matter what, it comes back to emotion and tying into or eliciting an emotional response. I think when we talk about market volatility like we've had this last couple of weeks. Yeah. And I know you and I've had some clients that have been elicited with emotional response.
How can you not be, though?
Well, I mean, but this is one where, personal opinion aside, but a lot of this is just not even manifested yet. Like it's projections of news. Like we're just starting to see economic data associated with implications from it. But a lot of the volatility we saw in the early part of April was just news, right? Like not actual substantive changes that went into effect. I would also say, making that emotional response because of that, like for example, and I always preach, if your time horizon haven't changed and your risk profile haven't changed, your investment narrative should not change. But I would say directly responsive to that, anyone who went to cash in the last couple of weeks, I genuinely believe that they're going to absolutely regret that decision 12 to 18 months from now. It might even be shorter than that, to be perfectly honest.
I mean, as of right now, it is.
What, was it a good decision or a bad decision?
Bad decision. I mean, just even since then, what we've seen in the market.
100%.
So
it's actually interesting. April closed out not that bad. Like, the volatility was extreme, but to have a depending on which index you're looking at, but down 4.5%. That's that's actually pretty typical of a month that you'd see intra-year, right? Like, so, and again, from our perspective, it's easy for us to, on a relative basis, remove ourselves emotionally. When we look at our own portfolios, of course, it elicits response. But the fact of the matter is that we have the ability to see outside of that perspective.
Do you feel like, and Chaz, jump in, you're the younger horse here. So from what you're seeing, but are you guys seeing with this market volatility that we've been witnessing, have you been seeing an uptick on social media or on websites about, different, get out of the markets or do this instead? Are you seeing, are people profiting more now because of the volatility, and they know that, so they're going to, continue to pump this more so now than maybe they had before?
Sure. I mean, I'll tell you right now, I don't really follow social media at all. Like I'm almost completely off outside of like stuff my wife posts.
Yeah.
But I don't follow most media sources outside of like, and I know we're going to talk about like what is credible, but like I have very select things that I watch and let in, because the thing is like data in, data out, right? Like if you're going to cloud your mind with toxic and cancerous messaging, then you're going to have a very jaded perspective. And I've seen that with advisors over my career, right? Where inundate themselves with these doomsday articles. And like, that's and of course they're very pessimistic, and that then translates into their investment narrative, which then translates to being too conservative, which then translates to their clients dramatically underperforming.
That's such a good point.
And then translates into an unhappy client, which means that the client ultimately lets them go. Right. And I think it's just really, really important. And essentially the narrative of this entire podcast is be mindful of what input you give yourself.
To answer Brian's previous question real quick, I do think there's an uptick in social media activity. And that's because when there's no volatility, it's a lot harder to produce storylines and to get people fearful or get people excited. Right. Now we're in a time where you can tell people to go all to cash or to pour money into the market based on, well, you see that the market's down 10%, the volatility has to turn back up, or it's going to keep going down. When we're in a low volatility time, there's less evidence, less convincing you can do to back that up.
Yeah.
But right now, there's a lot of, like you mentioned, fear mongering that can happen. And that has led to the uptick in social media posts, the uptick in bad advice being spread around, non-customized advice for each person being spread around. And that's obviously causing a problem.
That's a fantastic point. Yeah. And I think that you call it capitalist, right? Like they're just trying to benefit or materialize off of an environment like we're having right now. I mean, I hate to say it, but Trump makes it easy. Like, I mean, you got new news by the hour almost at this point, minute. I mean, even that one day in April where he said today's a great day to buy, and then next thing you know, the tariffs pause, market's up 10%. Like, boom.
Yeah.
You know, it's like if I were thinking about that maybe, and I really wanted to trade that, I would have bought just based on that comment. I wouldn't have personally, but you know, theoretically, you know, that's been a lot of the internet rhetoric post that statement, right? Is I actually saw coming back, I do watch some stuff. My wife actually sent me this, that if you put $1,000 into options on the S&P, that you would have 1.2 million just based on trading that news. I'm like, oh, okay. Like, to your point, right? How you started, right?
Yeah.
Like, and candidly, even if you were to do that, if you put your entire portfolio in there, like, oh my goodness, I can't even imagine.
I would be sitting at a Motel 6 alone and Lisa has the kids in the house if something like that happens.
Well, and I have another friend who, you know, he's in his 40s, but he actually retired because he hit crypto, right? And he put his entire portfolio into not even Bitcoin, but in one of the smaller ones that took off. He retired because he could. I mean, he took his 500,000 to 20 million, and then he's back to about $1 million, right? Like, I mean, so he made life's decisions based upon how his portfolio performed, and then, you know, he rode that wave, and
he never sold out or did anything. Just
don't get me started.
Kept it rolling.
Yeah, we had that conversation multiple times. Because he had credible sources, guys that he knew that said it was going to keep going up.
The internet told me.
No, these were actual friends. Again, not financial advisors, but I would say most financial advisors aren't going to tell you to put your whole portfolio in crypto either. So, yeah, it's all part of the narrative.
I don't think the CFP board would be feeling too favorable about that.
I mean, but there are advisors who are disciples of crypto and having a large percentage of your portfolio in crypto. As an example. So coming back to the question though, I mean, at the end of the day, this obviously goes viral. Why?
It's attractive. It gives you the in before everybody else. It gets you to either do one or two things. One, it allows you to be safe, right? We are emotional beings. For every dollar you gain, you feel 2.5 times worse losing $1. And if it's the fear mongering of, I got to provide safety, I got to get out, I'm avoiding losses, that's the one. And the other end of it is, you know, I am like like a friend of yours that, you know, did really good with a random crypto is, you know, I want to use this as a mechanism to grow my wealth instantaneously. So it's both ends. It's fear and greed at the same time. Chaz, anything you want to add as far as why this goes more viral?
Absolutely. Yeah. I think it comes back to education and
literacy.
Yeah.
Yeah.
And I mean, there's a huge lack of it, right? If you didn't learn about this stuff in high school or college and didn't have any education even after that, and you're not working with a financial professional and you haven't done your due diligence, and we'll talk about that a little bit later, but it's like, where do you lean back on?
Mm-hmm.
What basis do you have to support this information? And in my opinion, it goes back to a guess. It goes back to greed. Mm-hmm. It goes back to wanting to hit it big, but not considering the consequences.
Well, I think financial literacy is like the true pandemic that we're enduring. Mm-hmm. And by the way, it's global. It's not just U.S. I commonly talk about how less than 4% of Americans have $1 million saved. Less than 1% have $5 million saved. And you just look at cost of living and how it continues to accelerate. Like, that's a scary statistic.
Yeah.
The other reason I think that we see a lot of times this stuff goes viral is the confidence of the person presenting it. I mean, there could be a lot of people who are just total blowhards. They have no clue what they're talking about, but they say it with a lot of conviction. And that conviction is convincing and compelling. It doesn't have any underlying diligence associated with it. And people take action because of that. I would tie that back into financial literacy and being able to think independently, but it's very scary, in my opinion, because of the way the internet has developed and social media have developed. Like, anyone can say anything
and sound like they are the most expert of this topic. And everyone's an expert now. I mean, on Instagram, by the way, right now, I will tell you how many Chinese shipping experts are out there now. I don't know if you see this, but everyone all of a sudden right now is an expert at Chinese shipments coming in and not coming into the United States. Who is this guy? Are they a CFP? Are they a fiduciary? Are they actually in the practice of giving financial advice?
So let's pull on that thread. How do we avoid the bad advice? Right? Like, let's dive into that. And from my opinion, first and foremost, you need to have a financial plan.
Oh yeah.
Right. Like, that's the baseline in almost every one of these conversations. And I would say that you need to be talking to a certified professional.
Yeah.
And what is certified? I believe if they're not a certified financial planner, to me, CFPs are kind of the gold standard at this point.
It is.
And again, this is really focusing on the planning side, right? But like, a CFP is going to keep your emotions and fundamental allocation and structure intact, aligned with your goals, and focusing on a longer term perspective.
Yeah.
I think that and this is personal opinion, they have to be fiduciaries.
Yeah.
And so for anybody who doesn't know, a fiduciary is an advisor who is legally obligated to put that client's interest above their own. There's no hidden agendas, no conflicts of interest, full transparency. Yeah. There's no ability to get paid commissions. There's no proprietary products that they're selling, et cetera, et cetera, et cetera. And I feel like that is one where so many people claim to be fiduciaries that are not. Like, they're brokers, they're licensed. Like, sure, they might have the ability to act in a fiduciary capacity, but if they're still licensed, they can sell product, and that's a direct conflict. And if anything, I would argue, and by the way, the CFP board is doing the same thing, that if they have their licenses, they are not true fiduciaries, and anybody who touts that they are a fiduciary while they're licensed is in breach.
I think they're trying to do a good job with public education, to get that out to the mass, but it's also up to us as individuals to, if we're looking at our most critical assets and the monies that we're working so hard for, that we're saving for, we stress about, we want to make sure that we pass on to our kids so they have, a good legacy, or for their grandkids, is the onus is also on the individual too, to not buy in, or in the sense of, don't buy in, but go to a trusted source. Well, there's a lot of times clients will send me articles all the time, like, hey, what do you think about this? And it's my job to come at it with an open mind and read it and provide honest feedback to how it relates to their specific financial plan.
But I think coming back to it, the person that you're engaging, obviously, I think they need some level of expertise, right? Like, going to a friend or a family member, that's not always the best advice, right? And I also think, related to that, they need to be able to understand your situation. Like a lot of our customers work at very specific companies. We know those companies' plans very well. We know the tax implications of them very well. But related to the point you just made is you need to be able to understand them. Because I look at it as a financial advisor's job is to help you fix your problems. A really good advisor positions themselves to be able to anticipate what your problems are going to be before they actually happen. Well, this is a partnership, right? When every customer that we engage with, we are partnering with them. Their situations are going to evolve. The decisions that we collectively make are going to be collaborative. But the reality of it is it comes back to they need to understand the advice that we're giving and why we're giving it, which is directly in conflict sometimes to what's coming in off the internet. You know, like for example, I have a lot of clients saying, why don't I have everything in a Roth IRA? Well, for lots and lots of different reasons, that might not be the right decision. And I don't necessarily want to belabor this podcast on that, but like that's an example of a planning advice where it's like there's tons of internet articles on why you should convert everything to a Roth right now. And that might be a horrible piece of advice that has huge tax implications that we can't unwind, as an example.
Chaz, how are the young people, you think, with dissecting this information? I mean, do we think that there's a difference in generations as far as being susceptible to bad advice, or, you know, any comments there?
That's a great question.
I don't know if there's that much of a gap. I mean, I would say the younger generation is probably more chronically on social media. But I think one of the big problems is finding a source with the proper motivation, right? Are you motivated to draw clicks and views, or are you motivated to be a fiduciary like we are, right? If you don't have the proper motivation, what's going to make you try harder to give good advice, to give customized advice, to give long-term advice, not short-term? I mean, some short-term, but there's a long-term plan in place. And I think both age groups, young and old, can struggle with that, because if you're not analyzing someone's motives to provide you that information, you could fall susceptible to something that isn't the right plan for you.
That's a great point. But I would actually say that's completely age independent. And if anything, your generation might actually be more aware of that than an older.
The BS meter might be a little bit higher with the internet.
Just because you're more accommodated to it. Right. You know, it's funny. I always look at, like, if it says sponsored, you know that somebody's paying for something. Good point. If it's got a banner ad that you click on, somebody's paying for something. You know, one of the things that I like to do, and I love that comment you made, is understand how someone is being paid, right? Like if there's a monetization that's happening because of a click or number of views, you know, like at one point we got approached, we do a lot of digital content, obviously, but we got approached if we wanted to put banner ads on our YouTube page. I'm like, well, yeah, sure, we can monetize that. We have enough views at this point. However, I viewed that as a direct conflict to what we're objectively trying to do, which is educate our users. And so we decided not to. But there are plenty of other advisors who do. One of my very good friends who's on one of the big media shows, his company has a whole media entity associated with what they do. And if anything, their media entity is worth more than their financial services firm is.
I didn't know that.
And there's, I mean, again, you just understand where the compensation is coming from.
But that's also too, you say that, but that's also a question that everyone should ask of their financial advisor too, is how are you compensated? And if they can be clear and convincing, that's good. If you start seeing them squirm a little bit, then I would start off thinking, okay, what's the situation here? What should I be concerned about?
I think it's also important to use credible third parties to assess, you know, and so what I mean by that is, for example, you can go to FINRA's broker check. You can see if they're licensed. You can see if they have any disciplinary background. You can go to the SEC's website. You can see anything to assess based upon, is there any type of unscrupulous types of things associated with it. You know, like for example, and I'll just share this, but like one of the hiring criterion for Bogart Wealth is we won't hire an advisor that has a disciplinary notice on, and because one disciplinary notice on one individual applies to the entire firm. And so that's just, and I'll admit that's made it hard for us to hire sometimes, because somebody could have something from when they were in college and it was just, again, at the time, innocent and benign, but it's there and it's there forever. And they haven't done anything to get it removed. So I can't hire them. As an example, right? But like, to me, it's a reflection of the standard of integrity we have within the firm.
Yeah.
It's not something I would say we openly brag about, like when it comes to client acquisition. But the fact of the matter is, it's important. It's important to understand the integrity of the people that you're working with, the integrity of the advice, and the integrity of the offering. And it's all interconnected here. So, I think we've kind of bounced over our agenda a little bit here, but let's talk about bringing this back to your situation and your planning a little bit more. Chaz, you spent some time in our planning department. Like, talk a little bit more about how this potentially bad advice and how we manage it potentially as like somebody asks a question about a planning strategy or something and what we're doing to actually translate that to action for our clients.
Sure. So it all comes back to the long-term outlook. And this, I was sitting in on a meeting with Brian the other day, and this is something he had said to a client was, we're bringing this back to the long-term plan and making sure that we stay consistent with that, making sure we don't get too rattled or set off track by short-term events. Especially today, a lot of headline risk, a lot of headline volatility, I would say. But bringing it back to why we built the plan, why there's certain things in the plan, and how we can stay on track with that, whether it's spending, whether it's investment, staying very structured with that. And within my time in the planning department, that's one thing that even like you two would help reiterate when I sat in on meetings, was to always bring it back to that, no matter what might be happening.
But even still, world. Like when a client asks, let's say they get a piece of article, you mentioned that earlier.
Oh yeah,
and it's like,
I've gotten countless articles this month.
Oh, this month especially. Countless. But I'm just in aggregate, right? And to me, it's like, I look at it, some of it's market related, some of it's like advice and tactically related. Like, for example, Roth conversions while the market's down. I actually think it's fantastic advice, but it might not be appropriate for your situation. Yes. And so, that's an example where we do lean on data and numbers. Yeah. Because, for example, if someone's about to have a taxable event this year, whether it's consulting or restricted stock or whatever that's going to drive their income up, Roth conversion might not make sense as an example, right? Like, so yes, they saw this article about why Roth conversions are the best thing that they should do and they should do it right now. But that, again, doesn't necessarily mean that translates to a practical, executable piece of advice for you, right?
I also think when Chaz is working or had been working on these financial plans, we can run market simulations and we can give clients a high degree of confidence that if they stick to the plan that we've laid out and we know is going to bring success, there is a high percentage chance that this is going to work in various stress-tested market simulations. If the client's deciding, well, it's too hot, I don't agree, I'm going to cash, or I'm going to take all of my portfolio and put it in XYZ stock or crypto. As a fiduciary, I can't give you any chance of success anymore.
Of course.
I have no ability to forecast that. And so that just, I'm much more conservative. That would just scare the living bejesus out of me.
No, but I think it's important to recognize, I completely agree with everything you're saying. That's why when I come back to like, this is a partnership and our job is to help customers make bad decisions along the way. And optimize and get alignment. Now, if a client comes to me and says, I want to put, $100,000 or $200,000 into crypto, okay, go for it. That's not, obviously depends on the size of their portfolio, but that's not necessarily one that I'm going to like say, no, you absolutely can't do that.
Many clients do that this year.
Well, yeah, especially this year, last year too, but it's one where it's like, all right, we're going to carve off a piece and that falls into part of that long-term growth bucket. And
there's a place for it.
Yeah, absolutely. But I think coming back full circle to talking about advice that's on the internet, the reality of it is that there are so many different ways that people who have really no clue what they're talking about can, and even some that recognizing they might be credible sources, but they're giving an opinion that's their perspective that might not still be applicable to your particular situation. And I think it's important to stay grounded in your plan, to stay vested when it's hardest to stay invested, right? Because that's typically when people make the biggest financial implications to their long-term strategy. Let's kind of wrap it up. I think we've kind of bounced all over, but I think the whole purpose of this is to really educate on. There are a lot of things out there that may or may not have a direct impact on a client. Yeah. The goal really is to alleviate pressure on your situation, your plan. I think it's important to be vigilant, understand who you're taking data from. Everyone has opinions, but it, again, might not necessarily directly tied to your situation, your plan. And I think it is important. I know we're a little biased here, but it's important to recognize professional advice. And even us, by the way, right? Like, we have our opinions on things. Yeah. And I have a tremendous amount of conviction that absolutely, historically speaking, I've been right a heck of a lot longer than I've been wrong. But that doesn't mean in intermittent periods of time that I can't make a bad decision on something. But we recognize it comes back to the plan and it's aligned with longer term goals.
And take it from all three of us. If we were looking into something that wasn't our field, it wasn't financial, whatever it may be, if we don't know what we're doing, we're likely to ask for help.
Absolutely.
Or ask for expertise because we know from our perspective that we hope that clients ask us for expertise. We know that we sometimes need to ask for help. It's okay to not be an expert on something, but asking for help, doing your due diligence is the most important part of this.
Without a doubt.
Chaz coming in at the very end of his first podcast and just dropping a little great
gem,
line like that.
Drop,
Welcome to the podcast, Chaz.
Hey, thank you all for taking some time. Thanks, Chaz. Thanks, Brian. This was awesome. Appreciate it. The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.